Hi, good morning, everyone. Thanks for joining us for today's weekly research morning call. So, as usual, the Monday after our Singapore strategy and stock pick, as well as our US strategy and stock picks, we'll do a quick summary of it on the Monday. So, yeah, we have a few stock counter updates as well as our top picks. So, one thing to note is that today, Zane, our technical analyst, is not here with us today, so there'll be no technical analysis section for today. Yeah, so without any further ado, let me hand over the time now to our US team to talk about the US strategy and stock picks. Thanks.
Thank you, Darren, and good morning, everyone. We'll begin with the stock picks, US stock picks for the first quarter of 2024. So we'll begin with Airbnb. Thank you, Darren. So for Airbnb, for 2024, we expect its booking volumes to be a record high with about over 500 million booking volumes. And this is significantly higher as compared to the pre-pandemic lows of about 200 million booking volumes. And this is mainly because of the travel rebound. There are three key trends that the Airbnb is benefiting from. So first of all, the guests, they are staying for longer duration on the Airbnb properties. Basically, segment consists of about 20% of its total booking volumes, and which accounts for about 100 million annually. Since guests, they are staying longer for longer duration, this is mainly because of the flexibility due to remote work environment, and also guests, they are traveling cross border, and they are taking up international trips, mainly particularly to the Asia Pacific regions. And this is mainly because since the COVID restrictions, they have now eased. And secondly, the Airbnb's business, it's getting more profitable. So for 2024, we expect company to report a net profit of about $3 billion, over $3 billion, as compared to maiden net profit of 2 billion in 2022. And this is mainly because of the growth in top line growth. For 2024, we expect the revenue growth of about 15%, and also because of high operating leverage as it's focusing on its cost discipline. And the active listings on its platform, it has also been consistently increasing. It recently reported that it has about 7 million active listings on its platform, and we expect the company to benefit from trends like the host shift listing their properties to earn additional income, as well as the company, it has been innovating its platform and introducing new features. Last year, they have introduced features like Airbnb rooms and monthly stays, and it's also providing support and marketing to hosts. For instance, they have introduced pricing tools for hosts, wherein they can wherein they can view the pricing that have been listed by the other hosts in the similar region. So accordingly, they can place their daily rental rates. For Airbnb overall, we have a buy recommendation with a target price of $157, and this is mainly because we believe that it's the leader in this category, and it should benefit from shift to alternative accommodations. And it's also more asset-light business model, as the Airbnb is just a marketplace and it does not actually own these properties. So it does not have to invest into maintenance of these properties. Next slide, please. So moving on to Microsoft. So for Microsoft, we believe that there are two key growth drivers. First of all, it's a cloud service, Azure. Azure, it has a market share of about 23%, and we expect in 2024, we expect continued demand for this product, mainly because as the companies, they shift their workloads to the cloud, and also it has integration capabilities with Office 365. And for as an example, the company, it should benefit, it's providing the solutions like website and applications hosting, and it also provides to analyze a large amount of data, wherein the companies, they have integrated AI into their products. So Azure can help to data analytics solutions for them. And secondly, the Office 365 platform, we expect the continued demand to continue, mainly from large and small and medium enterprises in order to rising needs and workflows. So for 2024, we expect that the demand should continue, and the Microsoft, it has integrated AI into its product base across Office 365. Like in the word, it can help in generating contents, paragraphs, or editing tools like spelling check and Grammarly. So, and with respect to PowerPoint, it can help to generate the first draft of presentations, as well as to summarize emails. So these tools, it should help to boost the productivity for its users. And management has highlighted that it's witnessing early traction for its Office 365 AI tools. And with respect to its more personal computing segment, it has been declining over the last few quarters. But in 2024, it's expected to return to flat or more positive growth rate. This is mainly because it should its gaming segment revenue, it should contribute to this segment, mainly because like it has recently acquired its acquisition Blizzard company, and it should provide a boost to its game plan number of users. And so overall for Microsoft, we have an accumulated recommendation with a target price of $375. Next slide. So moving on to Salesforce. For Salesforce, it basically helps companies to handle their sales operations, as well as to provide enhanced customer relationships. And it has also providing solutions like marketing and data analytics solution. So it's witnessing strong demand for its core products like Sales Cloud and Service Cloud. And right now, the company, it's also focusing on multi-cloud adoption strategy, wherein it's cross-selling its products to its existing customers instead of adding in new customers. So basically, there's this customer 360 platform wherein the users, they get a 360-degree view, a holistic view of the customer, all the customer interactions that they have faced across the departments. And it's also cost efficient to them. And instead of managing various vendors, they just have one vendor wherein they can get various solutions under one platform. And the Salesforce, it has Salesforce, it has recently announced a price hike of about 10%, and this should help to boost its top line growth, since this was the first time in over a decade that they have introduced a price hike. So the price hike was mainly introduced because the company, it believes that it has also integrated AI across its product base, and it has increased value to its customers. So like the AI tools, like it can help to generate personalized emails or chat replies to the agents, wherein they can give personalized chat replies to its customers. And also, lastly, Salesforce, it has been focusing to increase or boost its profitability. Like if from about 3%, its operating margin is in FY25, it's expected to be about almost 19%. And this is mainly because of the job layoffs and its like focus on cost discipline and cost saving initiatives like real estate consolidation and careful sales and marketing expenses. So overall for Salesforce, we have an accumulated recommendation, and that's all for me. I would now like to pass on to Jonathan.
Thanks, Amrish, and good morning, everyone. So I'll be running through just three companies. First will be Alphabet, or more commonly referred to as Google. So essentially for Google, got a few key things. It's really mainly a digital advertising play, especially as the rebound is kind of in its early stages. Compared, if you didn't know, 2023 was a really poor year. 2022 was a really poor year for digital advertising. That was spilling over into the early parts of 2023. But what we've seen over the last few quarters is ad revenue for Google and other digital advertising platforms. It's starting to actually improve a little bit year on year. And this kind of comes as advertisers are looking at more resilient spending from consumers, and so they're thinking, okay, maybe now's the time to start spending a little bit more money on advertisements to kind of gain traction again after essentially cutting off the taps for 2022. When it comes to why Google instead of other companies like Meta and Snap and so on, mainly because they are the monopoly for digital advertising. They've got the monopoly in um, search advertising in as well as other platforms like just your web browser, Android phones, and so on. Another level, why we really like Google is that we expect margin pressures to actually dissipate. We expect sort of a significant expansion in margins for 2024, especially after the company cut a lot of headcount cut about 8 to 10% of their headcount, as well as reduce a lot of office facilities. So they reduce a lot of their spending. And moving forward, given it's kind of I guess digital advertising is a high margin business, we should expect to see an increase in operating leverage as the volume start to increase, and while a lot of the spending remains relatively flat. Um, and so this is kind of what we're expecting moving into 2024, especially in the early parts of 2024, after early signs of a recovery, kind of positive data coming out of the US for the fourth quarter, which is historically a very strong um, quarter for digital advertising companies. In terms of the valuations, when we look at it, it's a little bit on the high side, about 23 times forward PE, which is slightly above its longer term average, but we still think that there's a little bit more room to grow, a little bit more room to expand, especially if the industry is going to be recovering. We should start to see multiple expansion happening for companies like Google as well as Meta and so on. So we have on top of that, Google has been spending a lot of money on leveraging AI for a lot of its products. They've been AI isn't actually a new thing for them. They've been doing it for over the last 15 years. And what AI actually helps to do for them, it's not necessarily create new products, but essentially it's increasing efficiency for some of their existing products, for digital advertising, for cloud. And so what this does is it gives advertisers a little bit more bang for their buck in terms of spending. They'll be able to reach greater audiences that maybe they wouldn't have been able to target previously. And it's just kind of adding value to their product offerings. And so essentially what Google would do with AI is that they're just going to be leveraging AI to increase prices that they're able to charge customers, because more customers will be willing to pay high prices. We have a buy rating on Alphabet with a target price of 144 US. Next slide. Moving into my next pick, which is Nvidia. Most should be quite familiar with this. They're a very strong play on your AI boom. They essentially are the only ones that are able to support to provide the hardware and the infrastructure necessary for supporting such high loads of I guess compute. And so what we really like about Nvidia is that not only have they been able to increase their revenues quite significantly from pre-pandemic levels or even pandemic levels, but at the same time they've also been able to increase their margins quite significantly. If you look at the chart here, revenue is in blue, and you can see that there's been a huge spike last year. And at the same time, margins, which is the line in orange, continues to expand. They've been able to do this on a few fronts, mainly because they don't have to do that much capex, and the expenses are relatively flat. What they've been doing is that they've been essentially creating better products, selling these higher powered products at a more premium price, which are higher margin compared to the rest of their lower end products. When you take a look at who they're really selling to, and they're really just selling to cloud service providers and corporations that are really spending a lot of money and investing in AI, compared to just your typical GPUs that are in your personal computers. I mean, those aren't really that powerful relative to data center GPUs, and aren't really as high margin either. Another thing we really like about Nvidia is that they are continuing to diversify their customer base. So for right now, most of their customers are your cloud service providers, And slowly but surely, they're adding in more enterprise customers, so more corporates that are willing to, so they are looking to invest in their AI capabilities. And even moving forward, they are also starting to see sovereign wealth nations, sovereign nations in general, starting to pile into the AI trade as well. That they are looking to develop their own AI databases and their own generative AI kind of architecture and capabilities. And so these kind of players are actually coming in and piling in more money. And as they spend more money in investing in AI, most or a lot of this money will go into infrastructure and they go into a lot of the hardware components, which and Nvidia essentially is the only one that provides. I mean, AMD also provides some data center GPUs, but in terms of performance and efficiency, not really as comparable. Although it is a little bit cheaper, but for right now, demand far outstrips supply. So as long as Nvidia can keep up with the supply, it should really maintain their leadership position in this area. Right now, Nvidia is trading about 40 times forward earnings, which relative to the rest of S&P 500 is pretty high. But when you consider that they've been essentially doubling or tripling revenue growth year on year, do you think that at least in the mid to near term, 40 times PE is actually still a little bit undervalued in our estimates. So we maintain a buy rating on Nvidia with a target price of $645. Next slide. Moving on to my last pick, it will be Tesla. It's kind of just riding on the EV boom or EV trade. Right now, there are really only two players, Tesla and BYD, that you would consider to look at. BYD is a little bit more mass market, a bit lower price, even though margins have increased significantly. Tesla is a little bit more on the premium side, but they do have significant brand loyalty and are actually the largest outside of China. And so as EV trade outside of China starts to develop a bit more, it should really benefit Tesla, actually more than it would BYD. What Tesla has been facing over the last year has been a lot of margin headwinds coming from price wars, so that they're cutting their prices quite significantly to compete with other smaller Chinese EV companies. At the same time, raw material costs have been quite high since I guess during the pandemic, and so this has really put a lot of pressure on margins for Tesla and for other manufacturing companies. But what we're seeing looking forward is we expect these kind of raw material prices to actually come down a little bit, which should help to provide some relief on just margin pressures. At the same time, we do expect the price wars to kind of taper off a little bit as well, because it's been ongoing for about a year and a half now. You see that it is becoming a little bit unsustainable for a lot of the smaller companies that really don't have enough cash flow, and it's starting to look like there may not be that much benefit to essentially forego margins for market share, because it's quite clear that there really are 2-3 dominant players in the space right now. Another thing that we're looking at Tesla is, as more and more people convert from ICE vehicles to EVs, do you think this is more of a longer term trend and should stand to benefit, leading players like Tesla and BYD forward? Once you kind of establish your leadership position in these kind of industries, it does take some time for I guess some of the smaller peers to actually catch up and potentially overthrow your position as the leading EV maker outside of China. For these reasons, we like Tesla. We maintain an accumulate rating on it with a target price of 240. So that's all for the US side. I'll hand it over to Paul for the Singapore stocks. Thank you.
Okay. Yeah, thanks, John. So we're just going to run through a summary of what we presented on Saturday. I mean, that's what we usually do. Next slide. Yeah, next. Yeah. So we're just going to go, some of the themes we think for 2024 will be the sluggish growth. So we think that growth will be slowing down even in the US. Although headline employment numbers are very strong, but if you measure it on economic sensitive jobs, if you look at the red line, you'll notice that it continues to slide. So what is holding up jobs is mainly the non-sensitive ones like government, healthcare, social. The worry is that this red line is, you will notice it plunges usually when there's a recession going on. So if that contracts even more, then there's a further risk of a recession. But this is quite an indicator. But this is a lagging indicator, but it is also indicative of if there is a recession happening, that the downtrend is happening for economic sensitive jobs. Next slide. The one thing that has been holding up the US economy has been government spending. You will notice, based on this chart, you'll notice the 2023, there's a 2.3. Actually, the latest number is 2.1, but essentially there's been an additional 1 trillion boost to the US economy by the US government, roughly 3.5% GDP, which is roughly half of the growth that's experienced in the US. We think this will swing. We think fiscal spending will be a drag. So we think this deficit could actually come down. So what I was saying is that the deficit will shrink for this year. We think, because I think taxes will come down, because there were some one-off events that causes the government to stimulate the economy more than expected. One thing to watch is the CBO, which is the Congressional Budget Office. They will come out with their own forecast, so from there we'll get a better clarity of how much. But essentially what we think is the government spending is going to be a drag on the US economy, not the kind of stimulus that you had in 2023. Next slide. The other theme is rate cuts. So we think rate cuts will occur in the US, namely because inflation continues to trend down. If you focus on the red line, we think inflation could even hit close to their target by year end. This is the trend line. You notice the number there, 2.2. And the other reason why we think the rate cuts will happen is because the Federal Reserve is really ready. They did mention they are ready to do preemptive rate cuts. So even before they see growth slowing down, they are ready to cut rates. And even before inflation hits their target, they're ready to cut rates. So these are two reasons why we think there should be at least two. Although the market, whenever you hear these headlines that the market is forecasting 5 or 6, actually that's not really a real number. It's a bit of a binary number, because the probability market is probably forecasting maybe 2 cuts, but just that the way the futures market is structured is either you are expecting rate cut or don't rate cut, but it really doesn't mean the market is expecting 5 to 6 rate cuts. It's just the way the futures market computes in. Next slide. The thing for third theme is that we think Singapore will grow below trend. I think it's pretty evident from the job growth here. Exports is still holding up. Structurally, Singapore is still strong. We have population growth, we have FDI, but just as cyclically, we think will still be another weak year for Singapore. Next slide. I'll move on to the stock picks. Next slide. We normally just feature our absolute 10 model. I think for the next seminar, we'll probably do a quick run through of all the stocks that we cover. But for now, if you look at how we construct the model portfolio, we just pick the 10 stocks that we have the highest conviction, at least in the near term. The way we set up this portfolio is that 10 stocks is very concentrated, but we normally have a yield. So yield, you will notice there's not much capital upside for some of these stocks, but it's merely to anchor any volatility in the portfolio. Then we have a dividend and earnings growth. So these are stocks we think will generate some earnings growth. And then re-rating stocks that virtually what it means is a valuation expansion. So growth may not be exceptionally strong, but the PE can expand. For instance, like Keppel, they make some divestment gains and so forth. So in terms of the changes that we did, we removed CapitaLand, Escort, Propnex, and then we replaced with China Aviation and Valuetronics. Next slide. Then in terms of the thematic, the last presentation, everyone bugged us why there's no long-term stocks. So if you want to buy the theme, again, we like to do long-term themes because no after sales. So don't ask us anything about this stock until after 10 years. But if you want, but some of the themes out there, for instance, like digitalization, I think it's pretty evident most of us these days don't really use cash. So stocks like PayPal, where consumers continue to pay with digitally. So these are one of the trends. Continued use of cloud services like gaming and even Microsoft Office and so forth is all coming from the cloud. So these are the data centers like Keppel DC or even cloud service providers like Amazon. But then the AI team, we have an Nvidia. We also have AMD, but the preferred pick is Nvidia. So I think my own view is that AMD will just pick up whatever orders that Nvidia cannot fulfill. So right now, because Nvidia is short of capacity, so maybe that's why AMD is picking up some of this AI chip demand. Then Microsoft, because they can roll out their Microsoft Office with AI features in it. For healthcare, and also healthcare is a structural tailwind, especially in Singapore, because of the aging population. You have Refimed, Hyphens, and even QNM. These are all stocks that we have coverage. Then we a bit of tongue and cheek. We also had this so-called college fund. So if you have a teenage kid looking to go to uni, you know what should you invest in? Well, you invest in what he's going to spend, he or she is going to spend on. So he or she is going to spend on Spotify, that's for sure, more than Netflix. So if you ask a teenager, they may not watch Netflix, but they're definitely going to spend time on Spotify. Another thing is Elite. I guess if you're going to study in the UK, you must have collect this 14% yield, which my colleague Miao will discuss later. And then Google, because of the because everyone keeps on using YouTube. And the next is just these are the stocks that we like because of the business model. Essentially, these three stocks, apart from the branding, you will notice most of them are very asset-like. So when we speak to a lot of property groups, most of them want to become asset-like. Most of them want to be like a CapitaLand investment where you don't want to tap on the balance sheet to grow. So like someone like CapitaLand doesn't really need to tap on the balance sheet to grow because they can raise funds. And they have a very excellent, hospitality business, Escort, where the owner comes up with all the capital, have to upgrade the property, but all they do is just manage it and collect something on the top line. The HR Net Group, because it's asset light and they're growing the franchise in of course, PropNext. Next slide. So the first stock is Comfort. I think everyone, no stranger to everyone, but for 2024, we still think that it will be a year of growth for Comfort. So there are three buckets for Comfort. The picture here you see here is P2P trips. So thankfully they came out with this app, the Zig app, because the growth now is P2P trips. Everybody using the ride-hailing app to grow. You can see from the red line. The blue line is basically street hailing, which I think hardly less and less house consumers are using. But the three buckets of growth for Comfort is firstly taxi. So the last 10 months, you've seen them continue to reprice taxi prices. So in April last year, they actually reduced the taxi rebates, which is the discounts they give for when they rent out their taxis from 15 to 10. Then in July, they introduced a platform fee of 70 cents on Zig. Then end of this year, they also raised the commissions they charge for Zig. So all these benefits in this past 10 months, you'll see it in the coming 2024 because all these were done and then you get the full year effect in 2024. The second part is UK, where they are able to reprice their buses, and competition has also come down in UK, which in 2022 they suffered tremendously. I think they were losing money. Now they're starting to turn it around. So you get that benefit in 2024. The final part that can benefit Comfort in 2024 will be the rail business, which is the MRT. The problem is that they used to make like 20 plus million. I think right now the profitability is probably 1 or 2 million. It has come off a lot, mainly because of utility costs and the lag impact of passing through the higher price. So there's a lag impact. So we think 2024 can catch some of the better profitability because pricing lags. Because if the government want to increase price, they'll take a year to review, then they need the price. So we think that should be the next driver of growth for Comfort. Next slide. So for ThaiBev, what can we expect for 2024? So 2023 was a brutal year for them, but we think there'll be a growth year for them in 2024, mainly because Thailand is undergoing a very aggressive fiscal stimulus. So the table here is the profitability of ThaiBev. Then they also introduced lower taxes or lower alcohol taxes. So that will definitely be a stimulus. And the third part is we think the macro situation in Thailand should improve as tourism. The bonus or the unknown is whether Sabeco or Vietnam can recover. So that will depend on Vietnamese economy. If that happens, then you'll be probably at the tail end of 2024. The one that will be very weak for ThaiBev will be in Thailand because the energy drink Carabao. If you watch English League, English Premier League, you know this Carabao because it's a Carabao Cup. So anyway, there are energy, right? Red Bull equivalent energy drink. They decided to enter into the beer business in Thailand, and they have a 20% of the market kind of capacity. Doesn't mean they have market share, but by default, a newcomer comes in, there'll be very brutal competition. So I think the beer business in Thailand will be the one that should be the weak spot for them. But in general, with the whole macro uplift, we think it'll be another year of growth for ThaiBev in 2024. Next slide. Move on to Singtel. So Singtel, not only 2024, I think this re-rating for Singtel could continue 2024 and 2025. So this year you will have a lower cost. So Singtel just announced, I think, a few months ago that they're going to undergo a 600 million cost down in the entire group, mainly targeted at Optus. So you look at this chart. The bar here that you see is not profit, it's actually capex. So this is the amount of capex they continue to spend, and the profit doesn't go up. The profit actually came down. So the partly because there's very intense competition in Australia. But anyway, a lot of this cost that they're going to do, cost down of 200 million a year, is going to happen at Optus level. The other driver to the share price will be higher prices. So after many years, we're beginning to see higher prices in their associates, their mobile operations in Thailand, their mobile operations in Indonesia, in India, mainly for two reasons: because of consolidation. Most of these countries have become like a two-tier or oligopoly type of business structure. And then because cost has gone up so much that they eventually, everyone in the industry have to raise prices. The third share price driver we think will be the monetization. They have a plan to divest 6 billion. They've done 2, so they're trying to do another 4 billion of divestments and use this as special dividends back to shareholders. Something like what Keppel Corp does. Next slide. The last one is Valuetronics. Is obviously it's a small cap. We try not to use small cap, but we like this because this is a pretty compelling, at least for us. It's very cheap because 80-90% of the share price is in cash. This company has been listed since 2007. So this is so this is not like the last 1-2 years. So they've always been very conservative with the cash. They have like Hong Kong 1 billion of cash. And after 5 years of decline, they're starting to see growth again. So we think with the 4 new customers that they have, I think we will see the first half really saw like 40% growth. And then we think the high yield, because they're paying a yield of 6%, and there's another support in terms of yield, in terms of the share buybacks. They have another 40 million of shares that they plan to buy. The last price they bought, if my numbers are correct, probably like 58-59 cents. I think I need to double check, but this is another support to the share price. So with that, I hand over to Glenn.
Hey, thanks, Paul. Yeah, so for our preferred stock pick amongst the banks would be OCBC. I think there are several reasons. I'll go through 3 of the main points. Firstly, their net interest. I mean, if you look across the board, all the 3 banks have actually shown pretty strong growth in their net interest margins as well as the net interest income. And this is despite their loans growth dipping actually almost the same for all 3 banks. It declined by 2% for all the banks. Yep. So despite all this, OCBC surprisingly, actually, or maybe not very surprisingly, actually does have the highest net interest margins amongst the 3 banks. This has been for the past, I think, several quarters already. And this is mainly due to how they're able to take advantage of the high interest rate environment. And, they are also managing to sort of keep their funding costs quite low as compared to their peers. So how does this sort of positively impact them going into the future? It means that they are, when the interest rates start to taper off and start to dip, they might be able to more effectively take advantage of this and maintain that higher NIM as well. So for the second point would be their fee income. Their fee income has actually grown by 7% quarter-on-quarter for the third quarter and 2% year-on-year. So it has also grown to the highest level in 4 quarters. And with their recent sort of announcement with the Indonesian acquisition of the Indonesian asset, we could see this even growing further as they try to grow their wealth management income further. They've also mentioned several things about their sort of rehash, of how they are now working on this one OCBC group, where they are better able to sell overseas in the region. So, not just Singapore, where, let's say a customer comes to Singapore, they're able to refer them quickly to maybe say a branch in Hong Kong or even in China, or now in Indonesia as well, because they've acquired that asset there. So this will all help them to grow further their fee income revenue. And last but not least, we'll speak about this chart here. It's their CET1 and ratio versus their dividend yield. So OCBC has had the highest CET1 amongst the 3 local banks for quite some time now, mainly due to, I guess, they did not really do many acquisitions before that. So, UOB and DBS have done their Citibank acquisitions, which cost quite a bit. So OCBC has done quite a small sort of acquisition with the Indonesian asset. I think it's less than 200 million Singapore dollars. So this doesn't really impact their CET1 much. So they still have the highest CET1, is I think around 15% if you're looking at the full year FY23. And their dividend yield is also the highest amongst the 3 banks, around 6.6%. We did these rough calculations where we took an optimal CET1 ratio of 13%, so there's an excess of 2%, and we came up with this excess equity per share of roughly $2.50. Yeah, so it shows that they have this extra buffer of $2.50, which they would obviously try to look at to reach their optimal CET1 ratio. And there are several ways they can do that. They can have more acquisitions, but I'm not very sure if they're going to do that since they just acquired the Indonesian asset. And the second one, of course, which is what everyone is looking forward to, would be an increase in dividends. So I guess theoretically speaking, if you look at this $2.50, they could put it all back to dividends, but highly likely that's not going to happen. So we could probably see, just based on a very safe assumption of maybe 10%, that's 25 cents. We could see that increase of 25 cents or even more, or any increase would be good as well for OCBC. So that's the third positive for OCBC, where there's a large upside in dividends based on their extremely high CET1 levels. So as such, we do maintain a buy rating on OCBC with a target price of $14.96. That's all I have for OCBC. I'll now hand it over to Darren for the REITs. Thanks.
Thanks, Glenn. Yeah, so for the REITs, we have FCT as well of our topic. So this is our stable dividend income yield play. So for FCT, as you see the graph, their tenant sales are stable, about 17% to 20% before compared to above pre-COVID numbers. And this is about 7% year-on-year growth for FY 2023 as well. So tenant sales will continue. We expect it to continue growing, especially since the population in Singapore has also been increasing over the past year. So that's one point. So because of tenant sales increasing, during the negotiations for future rental for future lease renewals, there's also a good potential for them to have positive rental reversions. So we are expecting about 5% positive rental reversions for their suburban malls going forward. And this is also further underpinned by the fact that occupancy cost is right now is set about 15%, which is historically on the lower side. Their average is about 17%. So this occupancy cost basically is just the rental income that the tenants pay divided by their tenant sales. So as the occupancy costs perhaps go back towards this average of 17%, then likely they'll have to pay more rent as well during the when the negotiations are taking place. So we expect the FCT to have a good positive rental reversion in FY 2024. And FCT right now, their portfolio occupancy is at 99.7%. So that is almost full already, maximum capacity. And one more thing about FCT is that for FY 2024, they do not have any loans that are due for refinancing. So that's a plus, as you know, now interest rates have peaked, and when you refinance loans this year, you're likely to get loans that cost more as compared when you refinance perhaps next year when interest rates start to come down. So refinancing this year is not really a good thing if you have to refinance a bulk of your loan. So they are safe from that. Yeah. So that's FCT. We have FCT's FY 2024 DPU yield estimated is about 5.3%. Yeah. So next for CapitaLand Investments, we like CLI mainly because of their ability to grow its AUM and FUM, which is the real estate assets under management, which is on balance sheet, and the funds under management, which is the fee incomes that they earn. So their funds under management right now is at 90 billion, and they still have about 10 billion that are embedded and have yet to be deployed. So we expect the later half of this year, especially 2024, now that interest rates have peaked and perhaps it will start to pivot and fall. It will be easier for CLI to deploy capital as when you have a fixed cost of capital, then it's easier to make more investment decisions as you want to make sure you have a certain spread there. So if interest rates keeps rising, it's very hard for them to deploy capital as well. So we expect this events-driven income to improve as well. With more capital recycling going on, they have a 3 billion target to divest every year. It's unlikely that they'll hit this 3 billion for FY 2024 as the transactions market was quite muted. But we think 2024, it might be possible. Yeah, and like Paul mentioned earlier, so the CLI is their lodging management business is doing very good. Year on year is up 31%, and we expect this to continue to be their star performer, with travel continues to be very strong and RevPAR continues to grow. Yeah, so these are some of the reasons why we like the CLI. And yeah, so we have a buy recommendation and we have a target price of $3.68. I'll now hand over to Peggy to talk about Keppel Corp. Thanks.
Thank you, Darren. Okay, Keppel is among our top picks in the Phillip Absolute 10. The two key reasons why we like Keppel. First, the asset monetization is expected to gain pace this year after they acquired the M1 Capital. Keppel's target is to divest about 5 to 7 billion of assets between now and 2026, either through outright sale or injecting them into the funds under their own management. Some of these assets that could be divested include the legacy REIT assets, which is worth about 4 billion, which will return about 4 billion back to the Keppel Group. And the other assets that could be sold is M1. They have some data centers and also the real estates. So when they sell these assets, they put it under the fund management platform. They continue to generate recurring income from this and converting their model to be more like a CLI. The second reason is the acquisition of M1 Capital, which will be completed by this year. It's a major step for them towards achieving the FUM target of 100 billion by 2026. What's significant about M1 Capital is that it gives Keppel a foothold in Europe. It gives them gain exposure to the wide network of investors, including sovereign wealth funds, and so on. So Keppel is on the right track to restructure its balance sheet to become an asset-light, to be an asset-light model, and to grow the income based on a recurring base of the income. So and that allows us to value them on a PE basis going forward, which we think the valuation could be realized this year of their assets under in their balance sheet, with the more stable credit environment from 2024 onwards. Thank you. Next slide, please. Okay, ST Engineering. Okay, ST Engineering, the key story is this is a key defense contractor for Singapore. So we expect defense budgets to rise with the increase in geopolitical tensions globally. And Singapore's their ST Engineering's order books typically rise together in line with the Singapore defense budget. So, okay, that's the one. The second thing is that ST Engineering is the largest global independent MRO operator. MRO stands for maintenance, repair, and overhaul. So typically refers to aircraft and aircraft parts such as engine and components. So the rebound in air travel and airlines putting back their capacity into the network means more work to be done for inspection to demothball the aircraft. And also follow on will be heavy maintenance and line maintenance work as the flight hours increase. The other the driver of the MRO work for this year and next year, we see a very a substantial ramp up for MRO operators like themselves, as due to the recent aviation incidents, such as the Pratt & Whitney engine problems that were surfaced in fourth quarter last year. And then more recently, we have the grounding of the Boeing 737 MAX 9 aircraft. With this, we'll see many aircraft being sent into the workshops for inspection. That will create a big stream of orders for MRO operators, and also potentially can raise the rates for repair and maintenance. There's the two key arguments for buying ST Engineering. Next slide, please. Okay, China Aviation Oil. This one is the chart shows the China international passenger traffic has risen by like 12-fold year-on-year in the first 11 months of this year. Compared to 2019, this is still, the November numbers is still 45% below that of pre-COVID. So potentially there's a potential to double this volume going forward. Okay. CEO supplies the jet fuel for all the international flights that fly in and out of China, and currently is supplied to 5 of the top airports in China. But it is growing its share beyond these 5 airports to other airports such as Kunming. So potentially they are also able to grow their customer base from here. So that we think is a very compelling story. The second thing is that China Airlines, for those that are listed, you can tell that they have all turned profitable by into quarter last year. Recall China only began to open up only beginning of last year, but by third quarter the airlines are already profitable, and they turn in positive cash flows for the first half of 2023. So they also announced placing new orders for aircraft, taking deliveries of those aircraft that they had ordered, and the substantial increase in capacity by 2024. So all this points to a strong uptake for jet fuel in China from 2024 onwards. So we are positive on China Aviation Oil, and our target price is $1.01. I'll pass it on to Miao for the REIT. Thank you.
Thank you, Peggy. I'll go through the new initiations. First is aided commercial REIT. Yeah, next slide, please. Yeah, it's a UK commercial REIT with stable income from AA rated government tenants, such as Department of Work and Pension or National Defense. We like it because of its cheap valuation. It is currently trading at 14% dividend yield and 0.5 times price to NAV, which we believe is very attractive. The discount is mainly due to the worry of its high gearing. After the year-end valuation as of December last year, gearing was at 49.6%, but it has also been actively deleveraging. There's a recent 28 million preferential offering will entirely be used to pay down the debt, except the 1 million expense fee. And we expect them to bring the gearing down from 49.6% to 43.5%. This will also enlarge its debt headroom from 3 million to 58 million, thus enable them for potential redevelopment plans, such as data center and student accommodation. It is also committed to its divestment plan to monetize mature asset. 3.4 million asset has been divested with 12% above book value, and 2.4 million asset is ready for the next round of divestment, which will bring the gain down by 30 basis points more. Meanwhile, from the peak inflation of 11.1%, inflation has dropped to 3.9% in November last year, and will fall below 2% within 2 months. Bank of England is expected to have a rate cut by 1.5% by end of 2024. It is the way to play the interest rate cut, and it will gain in terms of property values, interest savings, and its attractiveness 14% dividend yield. Therefore, we initiated elite commercial REIT with a buy recommendation and target price of 0.36 pence. Next slide, please. Next is Far East Hospitality Trust. It's a pure-play Singapore hospitality REIT with 9 hotels and 3 service residences. We like it because we think the momentum is likely to sustain this year, especially with the recovery of flight capacity and return of Chinese tourism. With the 30 days visa free. On a whole year basis, we expect RevPAR to bounce back to 97% of pre-pandemic level. And due to a line of mega events such as Taylor Swift concert, Coldplay, Ed Sheeran, and packed MIC schedule, like the upcoming Singapore Air Show, we project a strengthened NPI for service residents, thus will drive DPU growth by 4.2% in FY24. Far East Hospitality Trust also has a very unique master lease agreement, which consists of fixed component and a variable component. Fixed component alone in FY22 generated 77% of the revenue and translated into 4% dividend yield, which we believe is able to protect the rate against macroeconomic uncertainty. Lastly, they also have possible overseas expansion this year. As one of the least geared asset REIT, Far East has leverage ratio of 32% and debt headroom of 900 million. They're exploring potential acquisition in Japan, ticket size roughly 70 to 80 million Singapore dollar, and is able to generate a positive carry of around 2%. There's also 18 million incentive fee post-divestment of Central Square, which they intend to use to cushion negative impact brought by the interest rate cut, the FEC, and targeting a whole year dividend yield of 6%. Therefore, we initiated Far East Hospitality Trust with a buy recommendation and target price of $0.79. That's all for me. I'll hand over back to Paul. Thank you.
Yeah, so thanks, Mel. So just to wrap up with some quick conclusions before we move on to the Q&A. Again, our macro outlook is just we expect global economic growth to be sluggish. Like you highlighted before, Europe probably growing at 0, US at probably 0.5 or even 1, and China just moving sideways. But what will cap the downside in equity prices, we think, is the interest rate cuts will cap any growth downside, and could also revalue assets, which should benefit more the REIT and even property sectors. We are overweight conglomerates, REITs, and telecommunications. So thanks everyone for listening in. We will move on to the Q&A. Thank you, everyone.
Yeah, I'll pick up some questions, but first of all, Zane is not here with us today, so there'll be no TA portion for today. Sorry about that. Yeah, I really see some TA questions, so I'm just going to dismiss those questions. Yep. Yeah, there's a question on Prime US REIT, LHN and Keppel DC REIT. I'll leave LHN to Paul. I think there's an upcoming webinar that we're going to host LHN as well. So if you're interested, please sign up for that. Yeah, so for Prime US REIT, the biggest issue right now for them is the year-end 2023 valuations that will likely impact their gearing levels. So their gearing is now at about 43.8%, if I remember correctly. Yeah, so they from this 43.8%, for them to breach the 50% limit, the year-end valuations have to drop by more than 13%. So in that situation, if the year-end valuations do drop at 10%, then Prime will likely be in a breach. So that's the biggest thing that we are keeping a lookout. And right now, the leasing momentum in the US is still have not recovered. Transactions as well have not recovered. And we expect Prime's occupancy to stay above 80%, however, because they have another tenant that's likely going to leave their property. So we expect the occupancy to remain to drop but still remain above 80%. Yeah, so but Prime US REIT is on a valuation standpoint is still very cheap, as it's trading at about 0.3 times price to NAV. And even though we take into account that 80% occupancy is still trading at about 20% dividend yield. So if you are a high risk taker, yeah, then you should invest. But if you are low risk and you cannot stomach the volatility of the share price, yeah, then you should stay away from prime US REIT. Yeah, so next is Keppel DC REIT. So for Keppel DC REIT, they came up last month that they announced that the Blue Sea, one of their tenants in China, they have defaulted on their installment payments. So the amount that they owe is about 9 million Singapore dollars. So Keppel DC, they're requesting them to pay out this 9 million and also to top up another $6 million, which is about 32.2 million renminbi of security deposits. So we think it's unlikely that they'll be able to pay. So the DPU impact for this for FY 2023 will be about 0.655 cents. So that is about 6.5% of our FY 23 DPU forecast of about 9.91 cents. Yeah, so this will definitely be a headwind for Keppel DC REIT, but a good thing for them is that because the Blue Sea, they have not made the payment, so now Keppel DC, they have the right to terminate the agreement for them to acquire the Quantum Data Center 3, because right now they supposed to make a final payment on Quantum Data Center 3, but then because when Blue Sea defaulted, they had the option to walk away from this transaction. Yeah, but silver lining for them is that recently, just a few days ago, previously 2021, they had this payment dispute with DXC Technologies, and so basically what happened was that DXC Technologies, they decided to give back some space, but it wasn't in the agreement that they could do so. So Prime is requesting about $3 million in damages, and right now the court has already ruled in favor of Keppel DC REIT. So yeah, they'll likely be able to get back, claw back some of this sum. So that's a positive for Keppel DC. Yeah, I'll leave the LHN one there. Yeah, the next one is CapitaLand Investment. Do they regularly ask for equity fundraising, be it private or public? Yeah, so to be more specific, since the IPO, CapitaLand Investment, they have not done any equity fundraising to ask for more equity from their current existing shareholders. So what they do is because of their fund management platform, they want to raise their AUM, or rather the funds under management, because they earn a management fee from this funds under management. So basically a bigger funds under management right now is 90 million. So if they can grow these funds under management, then they'll earn more management fee from that. So yeah, CapitaLand, they regularly raise equity from external third parties. Yeah, be it private or public. Yeah, so in FY 2023, they've raised over 3.5 billion. Yeah, so this is from a third party, so it's not from the existing shareholders. Yeah, so it's not really an equity fundraising. It's more like equity capital for them to increase their funds under management to earn that more management fee. Yeah, I hope that explains your question. Yeah, so next one, any updates on Manulife US REIT? Is it a buy now? Yeah, so Manulife, they came out with their restructuring plan, and then just a few days ago, their independent valuations for FY 23 was also out. The portfolio valuation was down 8%, a further 8%. So this 8% mostly came from Figura, which is their weakest asset in California. It was down a further 20%. I think it is down over more than 50% since it first was devalued. Because Figura, every time they did a valuation, it's always double-digit decline. So that valuation really shrunk. Because that is a very weak market in Los Angeles, California. So Manulife, as you all know, the restructuring also, they've also halted their dividends, and they're now doing their whole restructuring plan or recapitalization plan, where they pay off some loans, and then because of this fair value losses, they also will likely have some face some losses in FY23, but then they have the rental income right from the cash, because these fair value losses are non-cash in nature, so they still have their income from the rental income to be able to pay off the interest expense and pay off any loans, not pay off loans, pay off any financing obligations that they might have for in the future. So yeah, basically Manulife US REIT right now is more of a speculative play than a safe play. So if you are a really high risk taker, yeah, you can bet that in 2024, Manulife will be able to properly carry out their restructuring plan and divest some properties to bring their gearing down back to below 50%. I believe after the recent valuation decline, their gearing is still at 58%. So yeah, it's more of a high risk play for Manulife US REIT. You're just betting that they'll be able to recover and kind of fix their issues like with gearing and such. Yeah, so it's a high risk play. Is Prime US REIT? There's another question on Prime. Is Prime US REIT at risk of breaching any loan covenants due to expected valuation decline? Yeah, so I wouldn't say definitely no, or I wouldn't give an answer because they are still doing their final year valuations. So if their year-end valuations do decline by more than 13%, then yes, they will likely breach. So that will be a Manulife part 2 all over again. But yeah, we're just we're keeping a lookout. But then again, the assets, like I was looking at the Manulife's the valuation decline. Most of their assets were down single digit. Only those at very weak areas like Los Angeles, California, New Jersey, Washington DC. Only these states had a very large double digit valuation decline. The others were still single digit. So we are yeah, we don't really have, we're just waiting for them to finish the valuations and to update us. So we, yeah, but there is a risk that they might eventually breach. Yeah, but hopefully not. Yeah, I think I'll hand over the time to rest of my colleagues to answer some questions. Thanks.
Thanks, Darren. Maybe I'll just take this question for the banks. Very interesting question. Okay, so the question is, if interest rates do not ease in 2024 as the market widely expects, is this considered positive for the banks? So as maybe I'll just give a brief sort of background on what the interest rates do. So I mean, interest rates is really a double-edged sword for the banks. So when the interest rates are high, they benefit greatly from their net interest margins and net interest income. But of course, on the flip side, if the interest rates remain too high, loan growth sort of suffers for the banks. So we can see it happening, in all the market statistics that we are collating, as well as even the banks' most recent third quarter 2023 results, where we see a decline of 2% for all three banks. So even though they are trying to push as hard as they can to grow loans, it's quite hard because interest rates are really too high, even for the common person, right, to think of taking up any loan. So this also affects the SMEs as well. So it's both affecting both the corporate as well as their individual retail sort of loans growth. I think the only loans growth that we are seeing currently is the housing loans, because people don't really have a choice when it comes to housing loans, right? They have to take it up. So what will happen if the interest rates remain high? So as I mentioned, their net interest margins will most probably remain at these levels, but it could take a hit because their funding costs might start to creep up. So currently, the banks are doing their best to give as low as possible, maybe fixed deposits or even their current accounts, savings accounts, their interest rates. They have to earn that spread. So if interest rates remain high, they might have to increase these rates that they're giving to customers, which will effectively increase their funding costs. So, and also another point to note is that we might see their CASA ratio dip even further. Currently, it's around the to 19% range. So if this dips further, then the funding cost will increase for the banks, and this will mean that their NIM might take a hit, even though interest rates are remaining at this high and let's say there are no cuts. So we might possibly see a dip in their NIMs despite interest rates being maintained. And secondly, and I think the most important one would be the loans growth. So loans growth would probably dip further because the companies and even individuals are not feeling the need to take up any kind of loans, and this will also pose a sort of an issue for the banks because their net interest income also depends on loans growth. So it might not be necessarily very good for the banks. And last but not least, their fee income will also take a hit because things like their wealth management, even their investment banking and their brokerage fees, right, will take a hit because the investors are more interested instead of putting money in products or even in brokerage, they might just put it into high yield fixed deposits because interest rates are so high. So overall, I would say it might not be the best case scenario for the banks if interest rates remain at these levels throughout 2024. Hence, if we do see an interest rate cut, I think it will be quite positive for the banks because they would be able to sort of reverse that loans growth decline, which they are currently seeing. So NIMs will take a hit, but they are able to offset that with an increase in both loans growth as well as in their fee income when sort of market activity and capital activity starts to pick back up. Yep. So I hope that is a succinct enough answer for you. Thanks. I look through again. Yeah, I think that's all. I'll hand it over to the rest of my colleagues. Thank you.
Hi, I'll take the elite question. Hi, Manuel. What is the likelihood that elite commercial REIT would increase its distribution payout in the next 1 or 2 years? For this year, we expect the payout ratio to be around 90%. And this is to strengthen elite commercial REIT's financial position and also to de-risk the rate. In our view, the uncertainty around the interest rate. But from 2024 onwards, we are factoring 100% payout ratio. It have guided that the payout ratio will be restarted in the near term. And as Bank of England is having a rate cut soon, so thus should have some interest, should save on some interest expense. And there's also no more break clauses for tenants to have any more early termination, and therefore wouldn't hurt their cash position further. And next one is elite commercial REIT. How much will DPU and PB be affected by the recent preferential offering? For NAV is dilutive. Upon completion of the preferential offering, share base will increase by 21.4%, and therefore NAV per share will drop from 0.43 to 0.4 pence, and therefore price to book will increase from 0.63 to 0.667. Yeah, and DPU is also dilutive. Based on a pro forma distribution basis, distribution will increase to 14.7 million from 14.3 million due to potential interest rate saving. But DPU will drop from 11.3%, from 2.5 pence to from 2.82 pence to 2.5 pence. Yeah, because the share base enlarged. Yeah, that's all for me. I'll hand over to rest of my colleagues. Thank you.
Maybe I take the question on the oil related. Okay, the question is, team, appreciate any views oil related counters, for example, Seatrim, Rex International, etc. Okay, I'll go one by one. Seatrim, as we all know, last year they acquired Keppel O&M, KOM, sorry. So it was Seatrim is a merger of KOM and Sembcorp Marine. So they say the new management team promised to give us to tell the market how they post restructuring, what will they do to the company, and what sort of business will they be focusing on, and what are the assets what are the items in the balance sheet that they might find it no longer required. So that restructuring plan was supposed to be announced late last year, but we haven't heard anything even right now until now. So we believe that it's going to be a year. FY23, they will do a lot of they probably write off whatever they can, so to start 24 on a clean slate. So with that, 23 you can safely ignore. The 24 going forward, for C-Stream's kind of business is really to look at their order book. Since second half of last year, there's not net there's no new orders. They won a small order from Shell, but they also saw Empire Wind cancel their order for offshore wind installation. So the C-Stream's order books, 2/3 of the order books right now is from Petrobras, right? And we know Petrobras, they're still, C-Stream is also still undergoing this corruption investigation exercise relating to to their business in Brazil. Okay, so that has only started. Keppel, the old Keppel took about 7 years to get their corruption issues resolved. So C-Stream is just only began last year. So then the other 1/3 of the order book is mostly green related, and most of these so-called green are for offshore wind. And offshore wind lately has faced some headwinds due to the bigger players like Ørsted and so on cancelling or give up contracts, give up the plans to install wind farm, and demanding that the US government to grant them a higher tariff. So the offshore wind farm side is facing some turbulence, which will also raise the risk premium for C-Stream's current order book. So there's the uncertainty surrounding C-Stream has actually been raised post this event. For Rex, Rex is a developer and exploring oil exploration and development. So the price always reacts very closely, correlates very closely to the price of crude oil. We think if you are positive on the oil price, you think the price is going to improve, then is might as well just buy an ETF or oil ETF, because exploration, first you have to build a lot of hope into the results of the exploration work, and if they don't find anything, they will write off the whole entire investment that they have made, like what we saw for RH Petrogas in late December when they announced the write-off for a few. So for that, we are not, and also fossil fuel as a whole, the sector is not in favor due to the increased emphasis on renewables and sustainability. Yeah. So I hope I answered your question. Thanks. The next question. Hi Peggy, any outlook for Keppel Infrastructure Trust this year? Yeah, looks like I got to start initiating. Okay. Anyway, the Keppel, the same KIT, the same. We're waiting for a few things. One is how they're going to refinance the Keppel, the current Keppel Merlimau, and they also are looking to acquire the desalination plant out in the south. That they will need funds as well. So this year we will likely see them going into the market to, I mean, looking for more funds for this refinancing of the loans as well as acquisition. If they manage to refinance the loans, then at least we have another 44 million back into the distribution available for the unit holders. Otherwise, the distribution will have to be driven by like for instance in third quarter you see a jump in distribution. It's mainly because they managed to raise new funds. They kick the can down the road for the repayment of the loans down the road. So they're actually paying these unit holders what they from that. I mean in a way if you look at it. So that's been how they work on that, on the distribution, increasing distribution. So if they manage to raise new funds, then you can continue to see a higher distribution going forward. The other thing is in the order books also, I mean in their asset base also, they also have some offshore assets which again have this higher risk premium accorded to them. So we think the investors might like to be a bit more caution because of this higher risk premium. We might not be able to see an NAV improvement for the KIT. Thank you. There's another question for me. I saw a report saying the Chinese tourist is more interested in local tourism than international ones. Is this a ban or boom to China aviation? Yeah, if you are looking at leisure travel, yes, definitely the local tourism is taking up more share than the international tourism. So the local increase in domestic flights, domestic travel doesn't benefit China aviation. But internationally also we saw the international flights also rising very sharply. And they are very full. So suffice to say that the flights between China and US are still have not been restored. They still haven't put back all the slots that were taken up during COVID time. But because we're starting from a very low base, almost zero for Chinese international travel. So anything from here is going to look very sharp. And for CAO as well, for the business, the upturn will be sharper than the rest of the industry. And that's the reason why we are calling a buy on China Aviation Oil. Thank you. There's a question on Mermaid. Maybe I can try that one. Okay, Mermaid Maritime stock price has started to perform after it announced a bump up in their order book and subsequently reported a decent jump in Q3 profit year on year. Any thoughts on this company and if they are willing to join us on the lunchtime webinar? Mermaid Maritime, when they first listed, I recall the key selling point was they are the one that lay the undersea cable. So the vessels were very much deployed in the laying undersea cables that's used for telecommunications and so on. So this recent bump in order book is for dismantling this undersea cable. So yeah, the same undersea cable that they installed, I believe. So we haven't been able to meet them. They have not responded to our request for meetings. So if we just read it based on order book perspective, then we like to ask what's there going ahead forward for them. If the vessel type or the industry the momentum does not change for their business. Yeah. So that's the question that we have not got an answer for. If we manage to meet them, or if they respond to us, we'll definitely update our clients. Thank you. Okay, maybe my last question. Will the geopolitical tension in the Red Sea can escalate further on Wang Zhejiang shipping price? Okay, okay, let me look at this way. We don't know about the geopolitical tension, whether it's escalated or not. But how I would say it benefit Jiang Zhejiang. Jiang Zhejiang, most part of their earnings come from ship building, ship repair, they also have a shipping arm, but the shipping arm only has many bulk carriers, only have 2 container ships, right? So this Red Sea, the Suez Canal, is really about container vessels, container liners that could take on the Asia to Europe route. So the jump in freight rates, SCFI, we call it Shanghai Containerized Freight Index, that has doubled over the last 2 years, last 2 weeks. This is only on the Asia-Europe route. Why it has risen also because now that airliners like Maersk, they all have to, most of them chose to divert their routes through the Cape of Good Hope. That will take 13 weeks compared to what they used to take 10 weeks. So the 3 weeks extra shipping time means less capacity in the system and also longer time. So you need to pay a higher price to ship your cargo, and also of course the higher insurance premium. So Yang Zijiang's shipbuilding customers are mainly the ship liners like the Maersk, the Hapag-Lloyd. The top ones are their customers. So how this Red Sea tension impacts on Yang Zijiang is that they had a record order book of about 20 billion Sing dollars that will last them till mid-2027. So if you look at it, if the freight rates before this Red Sea tension was actually on the decline, and the risk premium has actually for Yang Zijiang ship has gone up because there's from analyst point of view, we are concerned that some of these orders could be cancelled, as the ship owners might find that it is no longer profitable for me to buy a vessel at this price, and then knowing that they're not sure how does the market looks like in 2027, so they might seek cancellation, right? So that is a risk there. And now the risk has reduced because freight rates are climbing back up. So that's to read it, that's why the Yang Zijiang, that's probably the reason why Yang Zijiang's price is moving, because of a lower risk premium. Okay, so and whether they will get more orders on the order book, possible if the continual migration to the sustainable fuel means that the ship owners now have to renew their vessels. They might need to place new orders with Yang Zijiang. But knowing that Yang Zijiang's yards are already full until mid-2027, unless they announce some capacity expansion, if a ship owners will place an order, you can only get delivered so far down the road. You might not want to do it now because things are so uncertain. Even from Yang Zijiang's ship's angle, they might not want to take on the order because they are also not sure how the metal prices or the other costs will look like going further down the road. So therefore, order book build-up could be slow from here. The angle to play Yang Zijiang ship is reduce risk premium for this company. Thank you. I hope I've answered your question. Sorry, a bit late also. Yes. I think I'll pass on to the rest of my colleagues. Thanks.
Yeah, thanks, back. Let me just take on some, then I hand it back to the rest. So for the first question on LHN, we still have a buy on this stock. So what should we expect for LHN? So LHN, for those who may not know, they're industrial properties, and co-living. So co-living, we think, will still be the main growth driver. It won't be as great as last year, because last year, the growth in rental rates, renting a home in Singapore surged up, and there was also a spike in in RevPAR for hotels. So that part won't be as robust. So maybe you're looking at a 5 to 10% rise in the rates that they can charge for co-living. But at the background, they are still growing the whole franchise. They are growing, maybe their target 30% room growth per year. But I'm not so bullish. Maybe mid-teens is really good enough. So what you should expect, why we still like it, is because they are behind LHN. They are building this co-living franchise, or Colivu. and at the same time, they're paying investors like 6% yield as they are building these franchises. So we think the end game is probably they're going to they have like 1/3 market share. They probably just sell off this franchise, I think, eventually in the longer term. The next kicker to earnings. So the third part, the next kicker to earnings would be this a bit more one-off. They are developing a factory units for kitchens. So sorry, it's a development where food industries can set up their central kitchen and so forth. I think there's a huge demand for this, so that's a one-off. So that's the growth driver. But just to note, this coming Friday, LHN will do the usual webinar with us on 12 p.m. On the same question, Keppel DC will also be doing a webinar with us on the 1st of February. So no, investors, if you do have time, do look out for it. If you want to know more details, again, you either join our Telegram group, or join our P3 community. You'll see the events, or of course go to the Poems page under education, then you got seminar. So you will see all these events. But coincidentally, LHN and Keppel DC will be doing one, and of course Prime will eventually do one with us. The next question, Paul, you remove PropNext from your absolute term, but yet include in your 2024 thematic carry. Can you clarify and your views on property related sectors such as CDL? Okay, I'll leave the property to Darren, but so absolute 10 is more like a 1-year view or maybe 1.5 years or 2-year view of the market. The reason why we took up PropNext is because I think property volumes, especially the new launches, the transaction volumes are much weaker than we thought. I mean, I was just looking through the number. September numbers were down 70% year-on-year, and then October was down about. November was down about 35%, and the rest 70%. So we're just very disappointed with the volumes of new launch. This 2023 is supposed to launch 11,000. I think it's running about 7,000. So a lot of the launches were pushed out into 2024. Some say it's because of the authority, some say it's the developers, but then most of the supply will be coming out this year. So we're just worried that the results might disappoint. Not dividend yields. I think their balance sheet is like 140 million. So they're more than happy to pay out to keep the dividend yield at, I think, 6%. That's my own suspicion or estimate. But just that I think the earnings momentum may not be strong because the volume of transactions for new units and secondary is just below, just disappointing. So I just don't have the figure offhand, but maybe the following webinar will give an update. Paul, are you still optimistic with hospitality, tourism sectors play? Example, Genting. So we still think Genting has momentum. At least the visibility we have is up to at least first quarter 24. Because first quarter 24 going to have Taylor Swift, I think it's enough. So there's Coldplay, Taylor Swift. There's also the Singapore Air Show. So I think all this is going to boost tourism numbers. The visibility we have is up to first quarter 24. So assuming Genting release the numbers probably in May. So I think in the first half, they still be fine for Genting. Then the second half, I'm a bit more cautious on the momentum. Because pre-pandemic, this share price was about, let's say, a dollar at most. Then right now it's really hitting there. You might move a bit, but I think maybe 110, my guess, 110 and all that. I think you're already hitting the upper bound because we again casino gaming, like we highlighted before, it's not a growth industry, and it's a really mature industry. That's that you're getting this big rebound as tourism recovers. So up to first half, I think Genting is still fine because the results, and there's so many events in Genting. I mean, that's the playbook I have. I will probably right or wrong, I really no idea, but that will be the playbook I have for. Okay, let me run through your Paul, your views on semiconductor for year 2024. I'm actually very cautious on semiconductor for 2024. There's two reasons. Let me just give you an example. I think a lot of us for semicon, there's UMS and Franken and so let's take their major customer, which is Applied Materials. So this is step one is let's say their main customer is Applied, but Applied has a lot of inventory now. I think if you listen to our webinar on Saturday, you listen to our SSP. So they have a lot of inventory. Again, the numbers is in the slide, but their inventory is very elevated. So that's the problem number one. And when you have elevated inventory, it also means the usage of this inventory that they have is also weak. And problem number 2 is applied customer. So this is UMS customer's customer. Their capex is actually coming down. So you have these 2 problems. You have too much inventory, although they say inventory is normalizing, but the inventory still looks very high for me, at least when I look at the recent results. And also number 2 is the customer end demand is also going to be weakened. But the big picture is that there is still growth in this coming in, but again below expectation. Is mainly because of the CHIPS Act in the US. There are a lot of startups right now in the US building foundries. Of course, I don't know, maybe half might explode, but but there's a lot of startups. So those who probably left Intel, then they do a startup, since after all the government's giving them money, CHIPS Act, right? So there's a lot of startups that are still having this demand. And of course, China is also hoarding all kinds of equipment. So, but despite this, the customers, that means the TSMCs and all that, Samsungs, they're still cutting their capex, foundry capex. So that's my worry, that the end demand is still weak. But anyway, in a nutshell, we are still very cautious. I think any recovery is going to be very tail end of 2024. That's my own estimates. Okay, the next one. Okay, sorry, let me just. How about Delphi? Okay, I think I haven't gone to anyone, or maybe Peggy can all chip in, but Delphi is definitely a very good company. And that by far, if you go into a convenience store in Indonesia, they probably have like 90% of the shelf space. So you want to eat chocolate, you end up just eating Delphi. So also a very good brand name, and so that's it. One of the reasons that hold us back from covering is just that the volume can be very thin, sometimes like 20 lots. And so, but it's obviously a very good company, and they managed to latch on to the growth in convenience stores. So all the Carrefours, hypermarts all really suffered very badly, but the convenience stores did well. And these are all like, in a way, like impulse buying, and that benefited Delphi. So Delphi, for those who don't know, is the largest chocolate maker, local chocolate maker in Indonesia. It's a very good company. I mean, just that we don't have coverage because the volume is just a bit too thin for us. Arising from the Taiwan elections over the weekend, what should investors take note of? Okay, so for those who may not know, in our P3 community, we actually give a weekly strategy every Monday, just to give everyone a review of what happened the previous week and what we think is the outlook. So for Taiwan elections, what it has done is just remove any tail risk of, the worst case scenario we know is either any conflict with China. So why we say that it is a positive is that the tail risk is removed, at least, is that the so-called popular vote for the ruling DPP has come off from 57% to 40% in this election. So if you assume let's say his popular vote was 80-90%, so you can imagine he'll be more emboldened and might push for the so-called red line that China has, the independence. So at least that tail risk is off. And I think Biden also chimed in and commented that their one China policy, and I think he mentioned that that don't believe that that Taiwan should announce independence. If I'm not he chimed in by that the US does not support independent Taiwan. So it's a positive in the sense that it just cut off the tail risk, which I think most investors weren't even pricing that tail risk. But again, for at least for investors, it's just that tail risk of a conflict or angering China has been lowered, not cut off, but at least lowered. Okay. With Taiwan election over, what are your views on China, Hong Kong? We don't have any particular views on China, Hong Kong. You got to ask our Hong Kong colleagues. For US markets, again, just as we mentioned, this just reduce the risk of any conflict or angering China, I guess, lack of a better word. Okay, I think let me answer this last one, and I'll pass back to the rest. Why STI is in limbo currently, and what needs to trigger its trend reversal? Okay, anyway, one way to understand Singapore's position is that just a fun fact, Singapore's GDP is no different than Denmark. So our GDP in Denmark is almost the same. So if you're global investors, do you really want to buy Denmark? Probably Denmark more, because Denmark has Novo Nordisk, has a MERS. So what could attract investors to come into STI or Singapore? I think would be if ASEAN does very well, my own views. I think Singapore is very matured, so it's very hard to grow. They would come to Singapore. My own view is that, of course, if the REITs, if interest rates drop very aggressively, then REITs rally, then of course investors can get debt that they can't get anywhere else. But the main thing is that if ASEAN really does well, it would benefit a lot of the stocks here, the banks and all the related Wilmar and so on. So I think for investors to really get excited about Singapore is, in the past was oil and gas, but of course that's not happening anymore. Most of them collapse. So the next would be if ASEAN does very well, then we will get into that tailwind. We'll ride together with the whole Southeast Asian market. Otherwise, what are some of the unique counters we get in Singapore? It's going to be challenging. So one way to frame it is that, so assuming you're a Singapore strategist like me, and then let's say you go to a global investors, and so you want to market banks where the next your competitor marketing Facebook, Apple. So it's going to be very tough to get global investors interested. They probably kick me out of the room. I tell them, you want to buy DBS when the next guy say you want to buy Facebook, right? So it's going to be challenging for Singapore unless the whole Southeast Asia does well. Yeah, just my own view. I mean, rightly or wrongly, most likely wrongly, but okay. Okay, let me answer. Oh, sorry, just one last. Hi, Paul. Can you give your view on the funds that investors will be getting after the de-SPAC by two other SPAC funds? Can they still monetize the free warrants? Yeah. Okay. So I think they are, if I'm not mistaken, because there's no de-SPAC, they are going to go for liquidation, which is so far unprecedented. So, but you should get your $5, that's for sure, because all the SPACs committed to 100% of the whatever they collected, that $5, and putting it into and safeguarding that. There's another term for it, I've forgotten, but actually that $5 plus interest should be repaid to the investors for those that did not do a de-SPAC. So the de-SPAC was like 17 Life, they de-SPAC. That's another word of, I don't know why they call it de-SPAC, but anyway, they just make an acquisition. Because the other two didn't do an acquisition, they have to go through this liquidation process. Never been done before, but I'm not sure how long it's going to take. But you should get your $5 because that has been safe. That $5 has been safeguarded. The warrants, if you got a buyer, then you better just throw it because the warrants conversion price is $5. So I'm not sure the warrants has any value now because unless it goes above $5. But it's free anyway, so let's throw it. If you get the free warrants, if you had subscribed it at IPO time. So that's why if you look through our reports when SPACs came out, we said that it was a free lunch for those who applied for the IPO, because at IPO you're confirmed gonna get back your $5 and you got a free warrant. So why not at IPO? So a lot of people sell back the $5 and just get a lot of hedge funds they did. But anyway, I hope I answered the question. I'll let the rest answer before I move on to the AEM question. I think.
Okay, thanks, Paul. Yeah. So anyway, good segue to the next question for the banks. Could you give some insight on DBS if possible versus OCBC that's recommended? So thankfully it's against OCBC, not like Facebook, like what Paul said, because I have no idea how to recommend it. But anyway, just for DBS, so we do have a buy call on DBS as well. I think for DBS, as I mentioned earlier in the presentation, DBS, the similar story, we look at the NIMs and the net and the fee income as well. It's a pretty similar story to OCBC. So the net interest margins have risen both Q&Q and year-on-year, mainly due to them being able to take advantage of the higher for longer rates. And also their fee income has also risen. I think this is also contributed by the Citi Taiwan acquisition. So if you look at their loans growth, actually the loans growth fell the same, 2%. But if you look at what Citi Taiwan contributed, it was a 10 billion contribution. The Citi Taiwan consolidation contributed 10 billion in loans. So if you remove that, I think the loans growth decline is slightly larger compared to OCBC. But I think the key points when you want to compare the two banks would be their dividend yield as well as the CET1. So DBS has done this their Citi Taiwan acquisition, which is quite large. So this lowered their CET1 now to around I think around 14%. And their dividend yield is also it has risen to around 5.5%, mainly due to if you remember back in their investor day last year, where they mentioned that they will be giving this 24-cent annual increment. So I think they're the only bank that in Singapore at least that has mentioned that they're going to increase dividends by a specific amount every year. And I think this was really priced in. So a lot of the investors sort of really priced this annual dividend increase. So they did push it forward. It's a bit of a confusing because it took analysts also some time to understand what was their thinking behind it. They pushed up their dividend increment, this 24 cents to, I think it was in the second quarter. So they pushed it up, and then they said that, okay, they already given it. So for 2024, this year, the baseline is that they are not going to increase. But of course, there's expectations that they might increase it further, right? So the dividend is sort of, if you look at their baseline, it's sort of kept. Whereas the other two banks are they're not saying anything about whether they're going to increase or not, right? So dividends will be kept around this 5.5%. But of course, I think analysts and everyone is expecting that there might be some increase. So if we look at overall, where their growth would be going, they have also given some guidance. So they said that the NIMs will probably be at the same levels, at least for the first half of the year. But some cuts will come in the second half of this year. But then again, they said that this will be offset by improvement in loans growth. And secondly, they are also very sort of positive on their fee income recovery. They did give quite a clear guidance where they said a double-digit fee income growth, and this will for 2024, where this will be sustained by their wealth management and credit card fees. Also, from their City Taiwan consolidation, where they will be able to see more credit card fees and their wealth management. And I think last but not least, so their loans also will benefit greatly from this City Taiwan consolidation. So we do have a buy call on DBS and a target price of $41.60. Yeah, I hope that is detailed enough for you. Thank you. Let me just look through again. Okay, yeah, someone just asked again. DBS 24 cents dividend increment, is this for every year or just FY23? No, so they say it's for the foreseeable future. They didn't say where the cutoff will be, but so you must take this with a bit of a pinch of salt, because they did say that this was going to be for 2024, but they pushed it up to, I think, in 2023. So they gave it early, which means that we might not see any further dividend increases for DBS, because we did ask very specifically, does that mean if you push it up, you're going to have another 24 cents for 2024? And they said, no, this does not mean that we are going to promise a 24 cents increment in 2024. So you can say that they already given it already for the 2024. I hope this is clear enough. So basically, 2024, they are not promising any 24 cents. But of course, I guess both analysts and investors are expecting some kind of increase. So it might not be as high as the 24 cents per year, which they have sort of promised. So next time, I guess we will see this 24 cents will be in 2025. Yeah. But then again, they might just push it back up again. So I'm really not sure. I think they will give more clarity when their full year results come out, and then I guess we can all ask them again, what do you mean by this? Can you just refresh, and I'll give an update when the results come out. Yeah, hope that is clear enough. Thank you. Okay, I'll hand it over to the rest of my colleagues. Thanks.
Please comment Prime, Keppel, Oak, Daiwa House, REIT in TP dividend yield. Yeah, so for Prime US REIT, we have a target price of 37 US cents, and it's a buy call, and we have a forward yield, FY24 yield of about 22%. Yeah, the other three counters we do not cover, so we do not have a TP or dividend yield, unfortunately. Yeah. What's the outlook for the property sector in Singapore? Yeah, so for property sector, we are neutral, mainly because of a few things. So first of all is the ABSD at 60%. That will really hurt the demand for especially the higher end properties, and especially like the core central region area. And next, 2024 there will also be quite a lot of launches, 11,000 launches. So there's a lot of supply incoming, and the government land sales also is in the 10-year high, like on the confirmed list, like 5,450 units for the first half of 24. So this is decades high for one half of the year. So because of the lot of supply incoming, and then as well as the headwinds from the continued headwind from the high end market, especially from 60% USD, we are neutral. So we expect the property prices to remain rather flat, or like perhaps 0 to 3%, like only grow slightly, or remain flat for this year. Yeah, last year it grew by about 6% for the whole year. Is it better to position in Capital and Escort rather than CLI? Yeah, so it's different, right? So Capital and Escort both also have is kind of lodging assets. Has Capital and Escort is pure lodging assets. CLI is have some lodging assets under the Escort brand, as well as some management of the funds fee income, as well as their real estate investment business. So it's different. But if you are more of a dividend investor, I recommend you invest in Capital and Escort, because it's more you're getting about 6% dividend yield. CLI, the dividend yield you get from CLI is not so high. It's around 3%. Yeah. So but if you invest in CLI, it's more for the capital gains, like the recovery in transactions volume, the recovery in events driven income, and the growth in fee income. Well, for Capital and Escort is more of dividend yield, more stable income play. Yeah, so it's more of a different objective, I would say. Yeah, so I wouldn't say it's a better position. It's more of what your investment objectives are. Yeah, I hope that answers that. Yeah, I think that's all from me. Yep. Oh yeah, there's one. What is the business risk for CLI model? Uh, yeah. I think Paul mentioned previously, a lot of property developers, they like CLI's model for the asset light, for being asset light, and this fee income model, which reduces a lot of like not so heavy on the balance sheet. So what's the risk for this CLI model is, I would say it's similar to all the other companies, where any potential devaluation in their real estate investment business side, they came up with a profit warning. So that is a risk, like the amount of the real estate investment value of the properties. But the risk is not as much as other heavy property developers, where they are more asset heavy. As a focus for CLI is more on the fee income, recurring fee income streams. Yeah. Okay, hand over to rest of my colleagues. Thanks.
Yeah, thanks, Darren. Okay, I think someone asked again. I think there's quite a lot of interest in this, the DBS dividends versus OCBC. Okay, maybe I'll just give a brief timeline on what happened, right? So for DBS, so for 2022, first 3 quarters, they gave 36 cents. And then in the year end, they gave 42 cents. So they rose it by 6 cents. And they just said this was a normal increase, right? And then they gave an extra 50 cents special dividend. So in the first quarter of 2023, they gave they maintained their quarter-on-quarter at 42 cents. But then right before I would say their first half or second quarter results, they held an investor day where they mentioned, and I think that was the key highlight of the investor day, was that they are going to give this 24 cents annual dividend increment, right? And then they just left it at that, and everyone was like, oh wow, that's very good. So, but then in the first half results of 2023, they said they rose it by 6 cents, and that was and they said that that's because they pushed up their 2024 target of 24 cents increment. Hence, now it's at 48 cents. So it was 48 cents in the second quarter, third quarter, and in the fourth quarter, we are expecting another 48 cents. But of course, they could give another special dividend like what they did in 2022, the year end of 2022. However, so going to 2024, we will probably, their baseline is that it will be kept at 48 cents or whatever they give in the last quarter of 2023. So it will be 48 cents all the way for 2024, and then only in 2025 they'll do another 24 cents annually. So you'll probably go up to, you just add 48 plus 6, there will be a 54 cents for 2025. Okay, so going to the question, this question asks, since DBS 24 cents dividend increment is not guaranteed, does that mean that OCBC is a better buy than DBS? Okay, so I think it is a guarantee, but because they have pushed it up for 2024, it's a guarantee, they've already given it. So the next jump you'll see, which they have guaranteed, will be in 2025. So does that mean that OCBC is a better buy than DBS? Yeah, I think there's a difference here between OCBC and DBS. OCBC, okay, as I mentioned earlier, DBS, they have spent quite a bit of money on the CT Taiwan acquisition. So their CT1 has been lowered to nearer to their optimal range of 12.5% to 13.5%. And they've also sort of really explicitly said how much they're going to increase their dividends by. So, you can take that at face value. But if you look at OCBC, the most recent acquisition they did was quite small, below 200 million Sing dollars. And their CT1 will still be very high. It's still the highest amongst the 3 local banks, as I've been saying. Even you compare to UOB, because UOB also did their own CT acquisition. And furthermore, we also did that slide where we showed the excess equity per share, which is around $2.50. So if you look at it, they just did acquisition recently, which will lower their CT1 slightly. And they still have this huge excess. So even if you take maybe just 10% of that, that's 25 cents per share. That's also a good increase to their current dividends. And even without any increase, OCBC's dividend yield is also still the highest amongst the 3 local banks, around 6.5%. So if you're looking at just a pure dividend play, then yes, I would say that yes, OCBC is a better buy than dividends, purely for just solely dividends, right? Yeah, but of course there are a lot of other factors and that an investor will look at, not just the dividends. Yeah, I hope that is clear enough. Thanks. I'll hand it over to the rest of my colleagues. Thank you.
I'll take the elite question. What are the future best risk for elite commercial biz model? So future risk we think is concentration risk. So 94.8% of the current list will expire at FY28, and about 93.2% of the income is generated from Department of Work and Pension. Yeah, and given the muted macroeconomic, muted office market and the work from home trend in their government segment, revenue is very susceptible to the renewal decision of Department of Work and Pension. Yeah, so they are actively working on diversifying the tenant mix and obtaining a clear idea whether DWP will extend the list from 2028 onwards. And it is also refining their mandate, incorporating other asset classes such as student accommodation and data center, which will bring a valuation uptick. Yeah, it's already over the feasibility test. They'll give a more detailed update, I think, during the full year result. Yeah, we'll update our clients after that. Thank you.
Yep. Okay, thanks. Let me just answer a few more, then I think we can, if you don't answer now, we'll probably just post it in our chat. What's your view on semiconductor industry and just the counters? I think we mentioned for venture, yeah, for venture, we always have a bit of a predicament because they don't really disclose who their customers is. So in the end, how we position venture is mainly almost like a macro bet. If the whole electronics industry is doing well, they should recover. But what disappointed was that even in 2021, only 2022, they did well because there was a bounce because 21. So even during the pandemic, 2021, 2022, when supposed to have a lot of demand for goods and electronics. Ventures results was actually quite disappointing too. So the last 5 years, they've not really even they've continued. They've never hit any new record revenue since for the last 5 years. So that's why we have a neutral call on venture. The challenge I have in answering any venture questions, they don't tell you who are the main sectors, the customers. They just tell you almost everything is their customer. Every sector is an important sector. So in the end, we just play it like a closed-end fund for electronics. It's virtually a macro bet. So that's why we always hesitate to comment much on venture, because they don't want to tell anything. All they tell you is just trust us. Which, okay, I guess not. The share price keeps coming down. What's your view on the new ETF, the JJJ, the AI? Is it good to subscribe? Okay, and we are one of the distributors of this fund. It's an AI Japan fund. My own unbiased view is you really have to ask the questions. Is this really AI? I mean, or are they using AI just as a marketing tool to sell this fund? So how to ask is that, well, anyway, they said this is a proprietary AI tool since 2019, but Gen AI was only launched in, I don't know, it only came out probably 2023 or 2022. So I'm not, and we want to build a large language generative AI model, it costs you a few billion. So I'm not sure what proprietary they are referring to that they built since 2019. And you really have to ask, like, what's so special about it? I mean, like what? How is it able to identify stocks that can outperform with this AI tool? What are the parameters? So you really have to ask a lot of questions. Or are they just using AI just a marketing tool? AI coffee, I'm not sure. I'm just saying AI made coffee, so does it mean the coffee tastes good? I'm just making things up. So just bear that in mind. If they charge it, if they don't really charge that much extra, then I think it's fine. Let's treat it like a normal ETF. But if they're charging a lot more just to have the AI logo, then like that, it's the same like a .com fund, right? Okay, is it really that much better? So you really have to ask and the final question to ask is not AI, like we highlighted in the SSP, is a self-learning tool. So it should actually get better and better, because think of AI like a child. The more data they collect, data means zeros and ones. The more zeros and ones that they collect, they can actually predict better or can give a better answer. So I'm not sure if this particular actively managed AI can actually work that way. And if it's really good, why choose 50 to 100 stocks? I mean, you're buying the whole market, right? If I'm really AI too, I just should pick 20 stocks and I have very high confidence level that I can outperform. Okay, I know I'm saying too much about distributors, so just don't quote me. Yeah. Okay. There's a few more questions. I don't think we are hitting the. Okay, let me just answer the one on the AEM. The last one. Notice a big drop in AEM price today due to inventories reported. Would this be a good long-term impact or just a blip? Good opportunity to go in now. How does AEM wrong stock inventory affect their P&L? Okay, so for the P&L, they will probably have to make a write-off. I'm not sure what was the source, but they probably have to, if you're doing bookkeeping, right? So you're gonna have to credit your, you probably have to debit your P&L and credit your inventory. By that, they say 5%, 7%. So you can just over 300 million. So assuming a 15-20 million write-off. So that's the first thing. Is AEM? AEM is a good company. I mean, don't get me wrong, because they have their own branded testing machine for semicon, system level SLA, system level SLT, sorry, system level test, which is used a lot in advanced chips. But the problem I have also is that if you look at their P&L, their inventory now is 300 million on a revenue of about 500 million. But if you look at 2020, their inventory was only 70 million on a revenue of 500 million. So I also worry that they have too much inventory on their books. So, but my own thoughts went to enter, like the question said, I probably want to wait. They'll probably announce their results incoming, then they're going to give a guidance. I'm not expecting a very strong guidance. To me, it's very unlikely they're going to announce a strong guidance in view of the whole market conditions. So I think there will probably be another 1 or 2 more rounds of negative news before. I mean, my own view before I will enter this stock. So the results for the fourth quarter is going to be terrible. Then you have to watch their guidance for revenue, which I think it won't be that great anyways. Then probably the third quarter, there's probably a better time to go in. But no, that's a good start. I mean, they have a very good product there, which is a system level test, which is being used by for advanced semiconductors. Yeah. Okay, okay, for IX Bio, what's your current view? And okay, so for IX Bio, I still like it, but just that the market doesn't have any patience for any biotech stocks that doesn't, I don't know, if it's not profitable, then it continues to develop new products. So I still like IX Bio, but you notice we dropped coverage I mean months ago, but mainly because there's no appetite for this stock in Singapore. If you're not announcing profit, then the investors won't reward you, even though you hit like development milestones in your product development. Yeah. Okay, so we hit the 1 o'clock. So I'd like to thank everyone. Sorry, there's no technical reading because I think Zain is on MC. So we hope to see you again next week, and hope everyone have a great day ahead and a great week ahead. So thanks everyone for your time. I know there's still some questions. We'll try and post it in the chat. If not, just post some of these questions in our community, and we'll try and get back to you. With that, I'd like to thank everyone for your time, and hope everyone and hope to see you again next week. And thanks for all your questions. So take care, everybody. Bye bye.